2,500 crore QIP. They raised money at a rough price of about 116 rupees. Shyam Srinivasan, the MD and CEO of the bank, joins in now. Good afternoon and thanks so much for joining in. We've seen a pretty strong response for your QIP. If you could first start off by giving us some details of the fundraise, how would your capital adequacy ratio improve post, this 2,500 crore coming in?
Like you pointed out, it was a very successful issue. We are encouraged by the response and also the pricing at which we could complete the deal. All our investment banker partners did a great job of lining up a good array of investors, both domestic and international. And happily for us, we did get about 20 new marquee investors, quite broad-based. I think the whole deal subscription was strong. We had, if I recall right, 49 investors doing the entire 2,500 crores. So fairly broad-based, good marquee names between domestic and FIIs. Interest levels were high. The pricing was at the top end. Very encouraging outcomes, and it also takes our CRAR to over 15%. And as you know, almost all of it is tier 1. So all in all, good outcome, very encouraging response.
Well, sir, capital consumption has been at around 100 to around 125 basis points every year. How long will the current capital suffice?
See, I think the discussion around hitting the market next is a little premature. But yes, your point on consuming about 30 basis points a quarter is quite true. At that run rate and speed, we are talking of another 350 basis points or so over the next 3 years. So we'll see, but as you can see, performance and credibility of the institution seems to be commanding the premium, and we are focused on that. Performance and credibility I'm quite confident that the next time we need to go to the market, which is 2.5, 3 years, whatever horizon it is, we'll command the kind of pricing and the respect hopefully we will get from our target investors. But at this juncture, the focus is to use the money that we've got more responsibly. And we think we have a good plan. Like I mentioned, we are consuming about 30 basis points or so. So that should continue.
Okay, using money more responsibly, would it mean that your loan growth would go up from here on? What is the loan growth guidance for FY18? And would you look to change your loan mix for FY18 also?
Like you pointed out, nothing is free. It's certainly available. But I would not alter our commitments to growth just because the money has come in. This was visualized as we were planning. I think our guidance at this juncture for financial year 18 is around 18 to 20%, which looks quite sort of possible as we look at the business and as we see how our Q1 has performed. And I've always held that the mix of the bank in terms of the portfolio will always be one-third, 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 in plus or minus in that range. So I think we will certainly ensure that the mix is quite balanced. The granularity of the portfolio is well maintained, and the particular focus on the credit quality and the asset quality remains. So growth, roughly 18 to 20% for the near term. If things open up, yes, that can step up further. But at this juncture, the capability of the institution is there to raise growth provided the markets are supportive. Book will be fairly even mixed across spectrum.
All right, Mr. Srinivasan, so you're giving us some guidance in terms of a loan growth, that's 18 to 20%, but you could also help us out with the FY18 guidance in terms of your net interest margins as well as your credit cost?
No, I think at the beginning of FY18, we had guided for a margin between 320, 325. We will certainly seek to work on that and deliver that or around that zone. Our credit costs last year blended was about close to 60 basis points. Given everything that we see, this year should be in that range, and that's what we are looking at as we look at FY18 on a full year basis.
You have meaningful operations in Qatar. Have the geopolitical tensions there impacted your operations?
Oh yeah, we have a large base across the Middle East and in particular in Qatar. Qatar is a big market for us in terms of remittances. Thankfully, at this very juncture, it's turned out positive, but I would say that's a point in time. Whenever there is any kind of local market confusion or concern, money actually flows into India. And we are the largest recipient of that flow. So at this very point, it hasn't seen any adverse action. But we have to look out to see how the local political situation in Qatar or some of the troubled states plays out. And this will, I think, take 1 or 2 quarters before there's clarity on how it's going to shape up. So I would say at the time I'm speaking to you, it hasn't seen any adverse. In fact, it's seen some minor gains. In the quarters ahead, we'll have to see how this shapes up. And my own feeling is it'll blow over. It won't become a large crisis. And there's too much at stake for the players there. But that's a personal view.
All right, Mr. Srinivasan, you spoke about various political angles, etc. The other big talking point really has been the farm loan waiver. Is it impacting your collections? Has customer behavior changed with respect to your bank at least?
I think yes. It's still not very pronounced, but certainly it is producing some kind of behavior that certainly is not the desirable outcome and understandable because everybody expects they will get their share, whether it's farm or education loan waivers. So we have to be watchful. I'm of the firm view that these waivers help one section, but it does produce a behavioral change. But I think that's the cost of doing business in India.
Okay, thank you very much, sir, for joining in. That's the word from Federal Bank post their fundraise via QIP, 2,500